On today's hot sheet, I'm discussing Goldman Sachs' updated forecast on the 2024 housing market and home seller profits. Today is Wednesday, October 25th, 2023, and I am Lisa Chinatti, and the hot sheet starts now. Good morning and welcome to the internet's only live daily housing show exclusively on BAM. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. First up is Goldman Sachs' 2024 forecast. Unfortunately, they do not foresee any relief for homebuyers in the near future, with sustained higher mortgage rates having a significant impact on housing turnover and nearly all borrowers who already own homes having rates below the current market rate. Items of note from this article. So first, mortgage rate prediction. Strategists, including chief economist Jan Hetzius, expect mortgage rates to remain elevated for the foreseeable future, dipping to just under 7% by the end of next year. What does it mean? Well, here's a breakdown. One, for potential buyers, this prediction signals a continuation of the costlier borrowing landscape. Higher mortgage rates translates to, of course, higher monthly payments and increased borrowing costs over the life of a loan, potentially limiting buyer power. This is going to require careful financial planning. Buyers may have to recalibrate their budget, perhaps considering different locations, property types, or sizes to find a home that remains affordable despite elevated financing costs. Importantly, it underscores the need to lock in rates at the point of purchase to avoid future rate hikes and volatility. For existing homeowners, the prospect of rates dipping slightly presents a potentially narrowing window for refinancing, particularly for those who locked in their mortgages at rates higher than the projected downturn. However, the dip does not necessarily mean low rates, just slightly lower than the current highs. Homeowners will need to conduct a break-even analysis to determine if refinancing will indeed save money in the long run, considering closing costs and the remaining duration of their mortgage. Investors eyeing the market must factor these rates as part of their ROI calculations. Elevated mortgage rates could mean fewer competitors in the buying market, as some potential homeowners might opt to rent instead. However, those same rates can reduce overall returns on investment properties, particularly if the strategy involves short-term buying and selling. From the seller's standpoint, persistently high mortgage rates mean that buyers are more cost-sensitive, potentially impacting home prices and certainly affecting market dynamics, like how quickly homes sell and the terms that buyers are willing to accept when purchasing those homes. Sellers need to brace for potentially longer market times and work with their real estate professionals to price their properties appropriately to be in line with current market realities. As agents and brokers and others in the industry, these predictions necessitate a two-pronged approach. First, it's imperative that we ensure that our clients are well informed and prepared for the financial realities of high mortgage rates. Secondly, professionals should adapt their strategies to account for a potentially slower market, adjusting advice on pricing, marketing, and negotiations. The strategies that worked even in the first half of 2023 may not necessarily be applicable as we enter the last push in 2023. So, end of 2023 home values. The bank's housing model, utilizing the well-regarded Chase-Shiller Home Price Index, suggests a slight dip in home prices. And by slight, we mean 0.8%, or really just under 1%, as we approach December of 2023. However, it's critical to interpret this data correctly. Despite this minor decrease, we're still looking at an overall increase of 3.4% in home values year over year. The paradox is due to a substantial rise in home prices that occurred earlier in the year, which has set the stage for a net increase despite the predicted forthcoming reduction. How can you use this information? Well, for potential buyers, the forecast indicates a market that continues to be competitive, though slightly less frenzied than the environment earlier in the year. The slight expected decrease might offer a marginally more favorable entry point into the market for a window of time. For current homeowners or those considering selling, the overall appreciation in home values is positive news for existing homeowners, reflecting an increase in home equity. Those considering selling their homes may find it advantageous, but timing becomes critical due to the projected dip later in the year. The latter part of the year might see buyers expecting more negotiable prices, more negotiable terms, and homeowners should also consider market dynamics in their locality, as local markets and even the micro markets within local markets may have differing trends. Once again, for real estate professionals, agents, brokers, and those in lending should prepare to offer nuanced advice that considers the market trends. Preparation involves setting correct expectations for clients, using the year-over-year increase to demonstrate the market's resilience and the potential that exists, while also strategically navigating the end-of-year softening. So, while the projected decline by the end of 2023 suggests a slight cooling down from the seller's market we've seen, the overall increase year-over-year underscores the market's strength and resilience. So, what's that mean for 2024 and where home values are going to go? Well, the predictions say that home prices are expected to increase, but be a little bit more modest, sitting at about 1.3%, mostly driven by tight supply, i.e., low supply, and high rates, tempering demand a little bit. So, the underlying causes, the primary drivers behind it are twofold. Like we said, the persistent tight supply of homes and the burden that high mortgage rates present to buyers. The former makes it difficult for buyers to find suitable properties, whereas the latter, by increasing the overall cost of home buying, potentially prices out certain segments of buyers. The intertwined factors are likely to dampen the vigorous growth we've observed over previous years. The slower rate of price increases could be encouraging news for buyers, suggesting the market isn't racing ahead as quickly as it once was. However, as always, the double-edged sword of higher mortgage rates and low inventory remains. So buyers in 2024 will need to prepare for a market where mortgage approval is much more costly and choices will be limited. Patience, preparation, and flexibility will continue to be the keys. For sellers, the landscape of 2024 will be a far cry from the bidding wars and skyrocketed prices that they've become used to through 2020, 2021, and even the early days of 2022. While not a depreciation, slow growth means setting realistic expectations about home value gains. Sellers should be prepared to work closely with real estate professionals to price properties attractively to capture buyer interest and balance between prevailing market rates and potential profit. Agents will need to adapt a highly consultative approach, guiding clients through a market less characterized by spontaneous activity and driven more by calculated decisions. When pricing properties and working on both sides, accurate valuations, data-driven advice, and patient client services will be absolutely critical. So, existing home sales. Predictions indicate that those higher mortgage rates and the lock-in effect will lead to existing home sales falling to their lowest levels since the early 1990s. As we continue to watch the predictions shake out for 2023, we will certainly see that 2023 will represent one of the slowest years for sales in more than a decade. Whether that number dips below 4 million annual sales will shake out as we watch the pending sales data that comes out over the next few weeks. But it is quite possible that we will see the total sales this year end up below 4 million. As we look ahead to 2024, one of the factors that we will be watching is the length of time that the average person owns their home in the U.S. You'll note that the years when the average owner has a lower length of ownership, there are more transactions. So as people move more often or trade up, as you will, and they move around, there are more sales. But with the tight lending environment, people are going to stay put longer. I suspect that we will continue to see the number increase for the next 3 to 5 years. So an increase in the amount of time that the average consumer owns their home. What I will mention again is that I believe over the next few years, we will, however, see a new trend emerge as those who bought prior to 2022 stay put longer and those who bought in 2022 or later move sooner. But given that the number of sales that happened in 2022 and 2023 was lower, it will take some time for the full impact of that shortened home ownership to be felt in increased sales. And finally, the last noteworthy bit in this article, Goldman Sachs also notes that limited supply in the housing market has kept home builders resilient to higher interest rates, but housing starts are expected to decline by 4% in 2024, particularly in multifamily starts, which are forecasted to be the lowest since 2013. Despite the rise in interest rates, home builders have remained active, largely due to the ongoing shortage of the housing supply. The limited supply has maintained the demand for new construction, keeping the market favorable for builders despite costlier mortgage loans, potentially dampening buyer enthusiasm. Goldman Sachs forecasts a slowdown in new construction, with overall housing starts projected to drop by 4% in 2024. This decline is noteworthy because it suggests that factors such as potentially lower profitability, repeat supply chain issues, labor shortages, and some regulatory barriers are anticipated to temper the pace of new residential building projects. The forecast is even starker for multifamily starts that would cover apartment buildings and condos, which are expected to hit their lowest point since 2013. Again, implications for the real estate market at large continue to be that the supply constraints will continue. The reduction in housing starts means fewer new homes entering the market, exacerbating current supply constraints. For buyers, means continued competition and potentially higher prices for available properties. Despite the decrease in multifamily starts, rent inflation is expected to continue, and new lease rent growth is projected to rise 3% annually for the next couple of years. So lots of interesting data there that will give us some insights into what's to come for the last portion of 2023 and some predictions for 2024 that will hopefully help us prepare not just our businesses, but how we're getting ready to coach clients. Moving on, the recent article published by Adam has several key areas to highlight today. Haley, can you toss up the graph showing the median housing values? And remember, for those of you watching, you can access all of these charts on BAMX. Sign up for BAMX at the link below. Use code LISA for 10% off your subscription. So the information provided indicates a continued upward trend in the housing market, at least in terms of prices, with the median nationwide home price reaching an all-time high of $350,000. Here's what this piece of data is telling us. The immediate information is that housing prices are on the rise, as represented by the median value. This is significant as the median reduces the skew from extremely high or extremely low values, providing a more accurate representation of the typical market scenario. As prices continue to climb, concerns may arise regarding the affordability of housing for average buyers, especially first-time home buyers or those in those lower income brackets. If wages and salaries don't keep pace with rising home prices, this could strain personal finances and widen economic disparities. And while the nationwide median provides a broad picture, real estate is highly local. Some areas may be experiencing rapid growth due to factors like population influx, job opportunities, or desirability among buyers, whereas others could be facing stagnation or even a decline. Historical trends show that continual steep price increases often precede market corrections. If the fundamental factors such as income levels, rent prices, or economic conditions don't support the heightened values, there might be a risk of prices stabilizing or dropping slightly as demand decreases. Important to point out, however, is that this is not 2008 all over again, and any correction is likely to be minimal. And the housing market is a significant component of the broader economy. Rising home prices could mean higher wealth for homeowners and greater profits for sellers and real estate professionals. However, they also offset construction, lending, and related industries, potentially leading to changes in investment strategies and economic policies. This article also highlights that the typical investment return nationwide has dropped below the levels seen in previous quarters, specifically below the 62% in the third quarter of 2022 and the peak of 62.3% in the second quarter of the same year. The decline in investment returns in the context of the housing market can imply a couple of things. First is that it's a cooling investment environment. A decline in the typical ROI suggests that the housing market may not be yielding as high a profit for investors as it did in previous quarters, often due to a variety of factors, including market saturation, increased housing prices, making initial investments more costly, or a natural stabilization following a period of particularly lucrative returns. And I think we'd all agree that throughout 2020 and 2021, we had some particularly lucrative returns. The high point of 62.3% suggests that there was a period when housing investments were exceptionally profitable, possibly due to a surge in demand, favorable economic conditions. And with this, I think we have the most at play here. Those interest rates started increasing in the last half of Q2 2022, and we've just continued to see that increase from that point on. We're definitely starting to see investor caution enter the market. Those lower returns appear to be making potential investors cautious. If the trend continues, it could result in a slowdown in investment property purchases. And while one outcome of this is that it could impact the number of sales in the multifamily sector, the more likely outcome is that it will create a bit of opportunity for those buyers who are also looking to own or occupy, who've been priced out or negotiated out by terms offered by more investment-savvy investors. The nationwide figure is an average, so it can mask regional disparities. And while the country as a whole sees lower returns, certain areas may still offer high ROI, which is attracting savvy investors. Such nuances are important for real estate strategies, and it's important for all agents to be educated on those. So moving on, Haley, can you pop up the chart on home sales by types? So this report also indicates that cash purchases made up 36.6% of single-family home and condo sales in the third quarter of 2023. It shows a modest increase from 36.4% in the preceding quarter, Q2 2023, and a more noticeable rise from 35.2% in the third quarter of 2022. The increase in cash purchases suggests a strong buyer market with more purchasers willing or able to avoid financing methods like mortgages. Not shocking given the number of boomers currently in the market. Those who have not just the highest equity in their existing homes, but also the highest net worth. These buyers have access to the cash and aren't afraid to leverage it to avoid the current interest rates while taking advantage of what they perceive as some opportunity in the existing market. Higher rates of cash purchases could indicate confidence in the real estate market's stability or growth potential. Buyers willing to invest large sums of cash might also believe that the market will continue to appreciate or remain strong. The sentiment can be especially pronounced if other investment vehicles are seen as volatile or less favorable. The increase in cash sales also points to a highly competitive market. Buyers use cash offers to stand out, as sellers tend to prefer those for speed, reduced likelihood of complications, and insurance of the buyer's financial solidity. This environment can particularly be the case in hot markets with low inventory and high demand, kind of what we're still seeing, leading to some bidding wars. The last big item of note in this article is a decline in property purchases by institutional investors in the third quarter of 2023. Here's a breakdown. There's a clear downward trajectory of the involvement of institutional investors in the housing market. They constituted 5.9% of single-family home and condo purchases in Q3 2023, a decrease from 6.2% in the previous quarter, Q2 2023. This change is even more pronounced compared to the same period in the previous year, where Q3 2022, where it was at 7.6%. Historically, the decline brings institutional investor participation to the lowest point since the fourth quarter of 2020. The comparison suggests that the market dynamics regarding institutional investments in real estate are reaching levels that haven't been observed for several years. None of this is shocking when we understand what has been at play with some of the bigger institutional buyers. Folks like Zillow Offers are gone. Opendoor's monthly purchases have dropped eightfold to levels not seen since the early days of the pandemic. The company has gone from purchasing 160 homes per day in June 2022 to purchasing less than 20 homes per day now. Yield Street started 2023 by predicting that they would reduce their home acquisition levels by more than 90% due to the combination of spiked interest rates and sky-high housing prices, significantly reducing the potential return for single-family rental investors. To date, in 2023, Yield Street hasn't purchased a single property. Yield Street has said that to resume purchasing, either interest rates would have to decrease or housing prices would need to decline, or more likely both. Other major players like American Homes for Rent not only stopped buying, but they've begun selling off their assets. So as we wrap up today, let's dive into rates. Mortgage rates tended to hold quite steady yesterday, finishing the day at 7.9, which was essentially the same as the day prior. So once again, we've avoided that dreaded 8%. It's easy to look at this and believe that it's unremarkable. However, there is something important to note. This is the first time in the past 2 months that we've seen rates hold around a consistent number for 3 days in a row. And it's only the third time that we've seen this happen in the past 5 months. And when you think about it from that perspective, it's easier to see just how volatile rates have been. The 10-year Treasury also remained relatively unchanged, moving from 4.863 to 4.865. Once again, noteworthy that we've remained relatively consistent or flat in movement there. And while it's not the number that we'd ultimately want to see, the fact that there is some consistency there is a welcome sign. What does it all mean? Honestly, a bit too soon to tell. We need to wait to see what the next set of economic reports tell us. 2 to watch for tomorrow. Jobless claims report is published at 8:30 a.m. tomorrow, and NAR's pending sales from September comes out at 10 a.m. So as we wrap up, that's all we've got to dig into on today's hot sheet.